Hello there, and welcome to the weekly outlook. Okay, so next week we've got a few currencies in focus. The main one being the euro, due to the ECB press conference on Thursday. Now, this is the long-awaited press conference where we're expecting to see the ECB add further quantitative easing to their current QE program. Now, there's a couple of things that can happen here, and don't be fooled into thinking that just because they add further QE that the euro is going to sell off. Obviously, adding further quantitative easing would initiate the devaluation of the currency per se, but what we've got to consider is the fact that the euro has dropped quite considerably already, and the market has anticipated what's been going on, and what's possible with this QE program, and has sold off already. From the 113.20 area down to the 108.50 price. Now, we had this bit of a rally on Friday due to the fact that the non-farm payroll figure came in. The actual figure for the non-farm payroll came in better than expected, but wage growth dropped, which was considered to be, the average hourly earnings dropped, which was considered to be slightly dovish, as it dropped down to minus 0.1 from 0.5. Now, there was quite a considerable hike in that average hourly earnings, so it's only expected to see a bit of a pullback, and I think the market probably overreacted to that slightly on this upside. So, I don't expect this to last. What's important is this Thursday meeting, because what's going to happen is, if the market doesn't get a substantial QE program that it's expecting, then the euro is likely to rally, even if they do add further QE to it. However, if they do add a substantial amount of QE, i.e. a rate cut, further asset purchases, then the euro will sell off. And we do expect euros to still be at parity, i.e. $1 to €1 by the end of the year. So we are looking for that sell-off in the euro on Thursday. But what we want to try and do is trade it so that we can be locked in, i.e. we can get our entry level, our stop loss at our entry level before the meeting, so that if there is any surprises and the market does, because don't forget, it's not just about what the announcement comes out as, it's how the market interprets it, okay, and whether some of it's priced into the market, or whether it's not. And at the moment, a lot of it's priced into the market, but the fair price for the current QE program, I would say, is down to about 105. So we are about 500 pips above that at the moment. So I think we've got a good chance of it selling off. And as long as we stick to key support and resistance levels, then we're in with a chance of making some profit. So what I would suggest next week is trying to take sales early on in the week, so that you've got a couple of days to hopefully get into profit and get those stop losses moved up to the entry level. Now, here we've got a nice area of confluence where the price spiked up to on Friday, so I'd look to see if that continues to push up there again, and hopefully take sales from that 11050 level, and then when it comes back down to the 11 level, we can get those locked in, ready for Thursday's meeting. So that's how I'm going to play the euro, and how I'm going to try and make profit from that one. The other one that's of interest is we've got Mark Carney speaking on Tuesday. Now, Mark Carney has been sort of, he can be a little bit sort of dovish. Sometimes he can come out across a little bit contradictory as well. So he's a little bit of a surprise sometimes. But at 9:15 on Tuesday UK time, he is due to testify along with BOE Deputy Governor John Cunliffe on United Kingdom's European Union membership before the Parliamentary Committee in London. So it could have an effect on the currency due to testify on the European Union. Obviously, we've got the Brexit going on at the moment. That kind of fell away from the news a little bit last week, and that enabled the pound to rally. Now, from last week's analysis, I had the target of trying to sell this from the 14250 level, which it just stopped short by about 2 pips on Friday afternoon. So haven't managed to get into that at the moment, but we'll see how that develops. If it it wouldn't be too late to get in on it, pushing back through the pivot point around about 142. But I'd like to try and get that 142.50 level. And I think Mark Carney speaking on Tuesday and bringing the Brexit back into the spotlight could have the selling scenario back on the pound and bring it back down to that 1.4 area again next week. So that's going to be my trade on the pound, is looking to sell at 142.50, or if I can't get 142.50, then I'll look to sell on the way back through the pivot point at 142, where the pivot point currently is at the moment, which is this area of support and resistance. Obviously that pivot point may change when we open up on Monday, but I'll be looking for it to go back for 142 anyway. So that's my trade on the pound against the US dollar. So we are still looking for US dollar strength. Like I say, that non-farm payroll on Friday, the market did interpret it as dovish with that low average hourly earnings, but the payroll figure itself was good, and it still shows growth in the economy. And at the moment, I think we're still looking for another rate hike from the Fed in June. Other currencies that we've got in focus, we've obviously got on Wednesday, we've got the Canadian dollar BOC rate statement, and we've got the overnight rate. Now, when we look at the Canadian data, the best thing to do when we're looking at rate hikes is to look at data and see how things have improved or how things have fallen away. In the last sort of meeting. So let's have a look at Canadian data. You can see that inflation has ticked up to 2%. So that's pretty good. Now, if we look at the other figures here and see where we are. Okay, so GDP growth has dropped off from 0.6 to 0.2. Unemployment rate ticked up slightly from 7.1 to 7.2. Inflation did rise from 1.6 to 2%. Interest rates remain steady at 0.5. So they've already got quite a low interest rate at the moment. Now oil has started to rally, which has shown a little bit of strength in the Canadian dollar chart at the moment as well. Now if we go to the Canadian dollar there, you can see obviously we had a trading plan on this as well last week, and which is executing quite nicely. We've still got further downside in that, still looking for that 1.3 level. Now I don't expect that to change next week, and I'm not really expecting the Canadian, certainly not expecting them to change rates based on that inflation rate at 2%. I think that's pretty good. The unemployment rate's a little bit of a worry, but it is a lagging indicator, so we should see that tick back down probably to about 7.1, maybe 7. GDP growth is a bit of a concern, but as long as inflation is holding up there, then I don't see a reason why they should change. If oil had been continually dropping and it dropped below $20 to the barrel, then I'll maybe reevaluate my situation here and think that they could possibly do a insurance policy rate cut, if you like, just to make sure that the economy is still growing. So I think at the moment, I think they're going to keep rates on hold, and then really it's going to be a case of listening to the rate statement to see if there's any forward guidance there to what may happen in the future. They may say that they're not looking to cut interest rates in the future, or it may be that they say something like, we're keeping an open mind with monetary policy, and rate cuts may be on the cards. In that case, the Canadian may sell off, but I think at the moment, if it does sell off, i.e. if the US dollar Canadian currency pair rallies up slightly, it will really just give us another opportunity to sell. And I think if you're not into this trade already, then a pullback to the 134 area would be an opportunity to jump into this and get in on the Bears bandwagon, if you like. The other one is the New Zealand dollar. Now, we've had a fairly good rally on the New Zealand dollar recently due to commodity prices starting to be starting to tick up as well. Now let's have a look at the New Zealand dollar data, because obviously when we're looking at interest rate hikes and what may happen with interest rates, we want to know what the data's been out and see what it is that the central banks are looking at to see whether or not we can anticipate what they may do. If I can just find New Zealand here. They don't put these things in alphabetical order, unfortunately, so it's a case of spotting it as you go down the list. And I don't seem to be able to find it at the moment. Where are you? will turn up at the moment. So now we've had mixed data from New Zealand of late. They did have some good housing data. Housing is pretty good, but when we see the inflation chart here, you can see we've ticked down from 0.3, 0.4. It tried to make a bit of a rally in July last year, but then January it ticked right down to 0.1. Now that is a major concern, really. And this is actually the opposite to Australia. Australia at the moment is inflation rate has ticked up. So New Zealand is a bit of a concern when it comes to that sort of when it comes to the inflation data. Now, if we look at GDP growth, now that has picked up. Now, GDP is always a good sign that inflation will follow. Now, the inflation in the previous year from 0.4 to 0.1 is quite a big drop. Interest rate is still very high at 2.5%. In fact, it holds one of the highest interest rates of the developed nations. So let's take that into consideration as well. They have got room to breathe here. Australia has started to their inflation has started to tick up. Their interest rate is only down. It's down at 2% at the moment. GDP, like I say, has ticked up, so that's looking not too bad. So it's a bit of a mixed picture here for New Zealand dollar, but it is fairly weak currency. And the other thing to consider with the New Zealand dollar is the RBNZ, the Reserve Bank of New Zealand, they want to have their New Zealand dollar kept weak against the US dollar due to export, okay, because that's a lot of their major GDP. Obviously, they have their milk auctions as well. Their milk production takes up about 7% of their economy, so they need to keep a weak New Zealand dollar. Now, it has fallen considerably in the last 18 months. If we take it to a bigger time frame, you can see that we have had this huge drop from 8,800, but the main thing that sticks in my mind is the fact that Governor Wheeler from the RBNZ wants to see the currency at 60 cents to the dollar. And you can see my analysis way back here, where they want to keep that. They want to keep it down to about. They'd be happy around about 60 cents to the dollar, between 60 and 65 cents to the dollar. Now, at the moment we're at 68, and as you can see on this chart here, it's at the top end of that trading range on the weekly chart. So they may not cut rates in this cycle, but I think we'll probably see some forward guidance, which is a little bit dovish, and I also think we'll see some talking down of the currency. So I do expect to see a bit of a sell-off, and this price at the moment isn't too bad. Between where it is 6.8 at the moment and 6.880, I think is a prime position to take sell positions on this New Zealand dollar. So I think I'm quite happy to try and sell into that meeting at the current price, with a stop loss of about 100 pips, with the potential of an 800 pip profit target. So there's quite a good risk reward ratio there, and it's worth the expense of that 100 pips to find out if we're right or if we're wrong. Okay, so they're the currency pairs I'm looking at next week: US dollar Canadian, New Zealand dollar US dollar, pound US dollar, and the euro US dollar. So hopefully you can make some pips, and I'll see you next week. Thanks for watching.